Good morning. I'm Jim Mintert, Director of the Purdue Center for Commercial Agriculture, and I want to thank you for joining us for our webinar this morning, focused on the 2018 crop outlook, focusing especially on corn and soybeans. Joining me today are my colleagues, Dr. Chris Hurt, who's a professor of agricultural economics here at Purdue, and Dr. Michael Langemeier, who's a professor of agricultural economics and also the Associate Director of the Center for Commercial Agriculture. So we're going to talk today about the corn and soybean outlook. We're going to start off talking about some of the updated information from USDA that was released last Friday with the Acreage report and also the Grain Stocks report. And then we'll talk about the implications, especially of what's been taking place with respect to tariffs and the impact that's having on trade and, of course, prices. So with that, Chris, let's talk about the stock situation. That was maybe the least controversial piece of information we've had recently.
Well, that's right. And again, fairly small differences from expectations here. Looking at corn first, the stocks number came in about 43 million bushels, higher than the trade expected. Now again, when we have 14 plus billion bushels of corn, 40 million bushels is not a real big number. What does it indicate? Well, maybe the USDA will have to reduce feed use a little bit. Maybe use wasn't quite as large. But again, I think that's a number they're just going to carry in their residual for now. So a slight tone of bearishness, but I think most people would have, in the trade, would have said not much change. Soybeans and wheat were both neutral on the stocks. That is, the expectations were basically met in the stocks report, and very little change from that expectation.
That was not the case, though, with respect to the acreage reports. Let's take a look at the acreage numbers. We did get a little bit of a surprise on the acreage side, and it was to the negative.
That is correct. And again, we had more corn acreage than was expected. Why is that? Well, probably once the weather cleared this spring, still timely planting on corn, and particularly Western Corn Belt went heavier to corn. These are the numbers on the June acreage relative to expectations. You can see there are about 760,000 greater corn acres planted than what the trade had been expecting. And the trade had been expecting a little bit of an increase. So I think a touch bearish there on the corn side. Soybeans, pretty neutral, came in a little bit smaller. Everybody said this spring with over $10 bean possibilities on the new crop, go heavy beans, and farmers did, but not quite as heavy as the expectation. Then on the wheat, we also saw more wheat acreage, and the very bottom line tells us where that wheat is at. It was the spring wheat acreage, again up in the upper Great Plains, where last year we had weather problems, smaller crops, strong prices, and that encouraged more spring wheat. And that's the primary reason that we got more wheat acreage, total wheat acreage, slightly bearish on the wheat.
Let's take a look at the total acreage situation. And again, a little bit of a bump there.
Well, that's right. And again, soybeans did come out on top this year, 89.6 million acres versus 89.1 on corn. Again, visually, they look like they're on top of each other, but soybeans slightly higher than we saw on the corn acreage this year. So again, the big movement since 2012 has been over to soybeans, 74 million acres on the purplish line back in 2012. Soybeans up to nearly that 90 million mark, so pretty strong movement. Now again, this is interesting as we think about next year. We're looking at the big impact of tariffs coming on soybeans and really reducing potentially the need for soybeans. So it could be that in the next 6 months we'll be talking about shifting back into corn next year, but still a lot to be determined on that front.
So if you take the 17 major crops and aggregate those along with CRP and hay acres, that's where the bump starts to show up. We picked up roughly 3 million acres, right?
Yeah, that's right. And again, we're over on the right-hand side of this visual. And this is would be a broad measure of really all of our crops, and we're getting CRP land in there as well. And we'll start about the middle of that visual, and you can see the bump up above the trend line in 2007, 2008. This was the initial boom period. We actually We're bringing some additional land into production. And then as we got into the recession 08, 09, that span into 10 and 11, and we did see some reduction in this total acreage measure. Got through the recession, then as we got into 12, 13, 14, we see that movement above the trend line again. The low returns for the last 3 years depressed acreage a little bit. And again, this isn't a lot of flex acres, but we probably have 3 to 5, maybe 6 million flex acres in the country that could either be planted or left fallow. And what we saw this year in 2018 was 3 million more acres that got planted or in hay or CRP land than last year, moving back above the trend line. Again, I think this is a reflection that the incentives for profitability look pretty good if you go back and look at late March, but especially on into April and May. And I think we brought some more acreage in and ended up with a pretty good spring. We didn't have much prevented plant. So more acreage, and that's not what we need today is more acreage, but we ended up with 3 million more acres than what we thought we were going to have versus last year. Now I'll mention we have up in the shaded area, if you go back to March and look at the increase in acreage of our major crops since March, 1.1 million more acres of corn. Well, now it looks like we not only have more acres of corn, but we also have good yields. So that's kind of a double whammy in terms of production and negative to prices. Soybeans ended up near 600,000. It was 580,000 more beans than we would have had, USDA had in their balance sheet for production back in March and carried into their June estimates in their WASDE. And wheat, about 500,000 more acres. More acres, and obviously looks like more yield as well this year.
Yeah, and so much of the attention so far on the collapse in prices, which we're going to talk about in more detail, has been on the trade side. But actually, a chunk of that is attributable to the really good growing conditions we've had here, especially since the 1st of June. And I think you got some information here that maybe addresses that a little bit. Take a look at those week-by-week estimates of where we are with respect to yields here in 2018.
Yeah, and again, we have to hold 2 fingers up when we talk about the major drivers of this huge decline in prices we've seen. And the first finger we hold up is obviously very good yield potential on this crop. And the second is the worrisome nature of tariffs that are in place and threats of other tariffs. But let's start out with the second column there that says corn in the U.S. The trend that USDA is using is 174 bushels. Again, that's not any evaluation for this year other than just a trend yield. We can take those weekly crop ratings and we can run some modeling that gives us at least an estimate. If we would finish the year with normal weather, what kind of yield would we end up with? And there's errors in these models, but I think they generally are all pointing in the same direction. And that is up around 179 bushel of yield, about 5 bushels higher than USDA. The report was out yesterday afternoon, yesterday at 4 o'clock Eastern Time, and that indicated on corn 178.8. I don't have that on the visual. So again, a little stronger even this week with the crop ratings. Let's look at the fourth column over. It says soybeans in the U.S., USDA trend yield 48.5. And you can see the models using crop ratings are coming out near 50 bushels. Yesterday's run was at right around 49.9 as well. So again, 50 bushels. And a lot of the trades talking 180 bushel corn yields this year. Of course, those would be new records. Last year, 176.6 was the record. In terms of these crop ratings, they go back to 1986 that USDA has been doing this. And we've been running the third, fourth highest ratings in 30 plus years. So you're looking at a crop that's at the 85th, the 90th percentile overall of the crops we've had in the last 30 plus years. It's a good crop at this point according to the USDA weekly crop ratings.
So Chris, it's probably a good time to point out that these are estimates of yield based on those crop condition estimates that come out each week. USDA's first objective estimate of yield will actually be released in mid-August based on August 1 conditions. So until then, we haven't actually seen anybody go out in the field and make objective yield estimates. But nevertheless, these models over time have proven to be pretty reliable.
And what is reliable is if you go to the end of the growing season, say get out near the end of September, you look at those ratings, well, those are pretty significantly related to yield. Now, when we look at ratings at the current time around the July 4th time period on corn, the July 4th ratings are about 80+% correlated with the final. You go back 2 or 3 weeks ago and those were only 30 or 40% correlated. But you get to July 4th and you really begin to say those numbers, you have to take them as fairly significant. It's not to say we can't have major changes in this crop from this point forward, but when you get 80% correlations, you're beginning to zero in. The next 2 to 3 weeks, 2 weeks from now will be 90% correlated with the final. So it's the window to have major reductions in crop size is really closing in the next few weeks.
Narrow, particularly on corn, a little less.
That's correct.
Less true on soybeans.
That's exactly right. Should have mentioned that.
So let's think of that. Let's take a look at the updated longer-term weather forecast, Chris.
Yeah, so we're saying, you know, with the readings we have up to this point, with the weather we've had to this point, we're at the 85th, 90th percentile on crops for the last 30 years. Looking good, lots of soil moisture in general. And as we look out for what we can get from the weather forecast, this is the seasonal forecast for July, August, September. And on the left-hand side are temperatures. And as you might guess, we've tended to run higher temperatures in recent years. And National Weather Service continues to suggest we'll have above normal temperatures for the primary Midwest, other than the northwestern part of the Corn Belt, where they have equal chance of warmer, normal, or below normal. Over on the right-hand side, again, most of the Corn Belt and even upper Great Plains, EC, equal chance for precipitation to be above normal, normal, or below normal. And I think there's pretty high odds of those three. It'll be above normal or below normal. And all that really indicates is National Weather Service says we can't see anything in our modeling that we could make a call. Does that say it will be normal? No, it doesn't say it'll be normal, but they just don't have a reason to believe they could go above or below here. So I think what we see in the weather forecast, we have above normal temperatures, we have rain in the next week, we have maybe some drying out in the western Corn Belt 2 weeks out, but the whole set doesn't suggest right now that we're going to have a really hot, dry period that gets this crop into trouble. I think the best bet at this point is that we may have a short period of stress, but you can't count on that at this point to say that we're going to get a recovery in price based on weather stress. On the other hand, can you say assuredly we've got this big crop? Not yet. Maybe on corn, 2.5 weeks from now. Soybeans, that better be a month from now before we can really say that.
And Chris, I think maybe one final point on the weather is just think about the transition that took place from late May to here we are in early July. In late May, although the crop in many locations went in pretty good condition, we were starting to talk about dry conditions. There was starting to be some surfacing of talk about the potential of moving into a drought in June if we continued to be warm and we didn't get some precipitation soon. And then, of course, we turned the corner into June, and what do we get?
Lots of rain.
Timely precipitation throughout much of the Corn Belt. In fact, in some locations, maybe a little too much. So a pretty big transition took place there in June. And I think maybe that's a little underappreciated sometimes in terms of when we talk about, from the media perspective, why prices have declined so sharply.
And there are some areas that have had too much that are showing some stress from that. There are some areas that that are subsoil moisture is not sufficient, could get into trouble. But when you look at the big picture, you know, I think we have to be talking the odds of being above normal on this crop would be very high at this point.
Yeah. So let's take a look at the ending stocks projections, Chris, and you've really done two things here. You've got the USDA numbers up there, but you've also got and those USDA numbers, the most recent ones now are almost 3 weeks old. And then you've got some implications of where we might be today given the yield projections you just put up on the screen.
Yeah, we'll look at the two lines at the bottom. The blue line is for corn, and what we see there, and this is reflecting the USDA data, as Jim mentioned. The June USDA update was done around the 10th or 12th of June. And it is showing 2 years over on the right-hand side, 17 and 18, tightening of inventories or ending stocks on corn, and we're measuring ending stocks as a percent of use here. You can see last year at 14.2%, dropping down to 10.8%. So this is one of the things that gave us our spring rally. It was the anticipation that 2017 we had started to reduce our inventories, and we were going to reduce those further in 2018, and 2018 was going to be the turnaround year financially for the farm sector as we got better corn prices as well as better bean prices. Now the numbers we're going to show you with the updating the weather improvement and the acreage increase on corn, we go from that 10.8% to 13.2%. As indicated there on the visual. Now the 13.2 will still be a little tighter inventories than last year's 14.2, but some of that bullishness, some of that anticipation that we were going to turn the corner is taken away from the higher corn acreage as well as the higher yield potential. The red line is soybeans. A beginning of the turnaround for soybeans, getting beans back towards the $10 mark for the 18 crop as we dropped USDA suggestion carryouts down to 8.7%. Now with a little higher acreage numbers on the soybeans and with the better yields we're talking about and big question marks on exports on soybeans, that's the tariffs. We're dropping that, or increasing, excuse me, up to 10.8% on the numbers we're going to show you in a minute. Now that is under the 12%, so it's a little bit of tightening of soybean stocks for the 18 crop, but not much versus 17. And we still have the issue of how big will tariff impact be on the soybean exports.
So I think that chart's really pretty interesting, Chris, because that really does indicate how dramatically things changed in the course of about 3 or 4 weeks here. If you think about taking the ending stocks from 14% on corn to roughly 11%.
Right, tightening.
And then all of a sudden, instead of doing that, we're looking at going from 14 to maybe 13. And the same way on soybeans, we were looking at going from 12% ending stocks to around 9, and all of a sudden now we're looking at going from 12 to 1, or 12 to 11. That's a big shift in a short span of time and really does explain a chunk of the weakness that we've seen in prices here over the last few weeks.
Well, I think that's right. And for individuals to say there's no reason for these declines, you know, I think the point is there are fundamental reasons, and then there's uncertainty that's in the entire tariff situation for our exports.
That's right. Well, let's take a look at the balance sheet in maybe just a little more detail.
Yeah, let's go back to the left-hand side of the numbers there. So that's the USDA's numbers for the 17-18 marketing year that we're finishing up right now in July and August as we finish marketing the 17 crop. Go to the bottom sets of numbers there, 2.1 billion bushel carryout. USDA is continuing to use a price average for the marketing year, U.S. farm price of $3.40 a bushel. The next column to the right of that is for USDA's projections for the 18-19 marketing year. That would be the June 10th or 12th release for projections for this 18 crop. Go to the very bottom there. There's a substantial tightening of those ending stocks, 1.5, 1.6 billion bushels, with U.S. average price rising from $3.40 to $3.90. So maybe people will come back and criticize USDA saying, how did you figure we're going to get 50 cents more? But another piece, tightening of the U.S. inventory, but world corn inventory was really getting back to the levels it had been in 2012 and 13. Now, a good bit of that is China reducing their corn stocks, but still, world corn stocks were really tightening, so that was a realistic number. Then we'll go second column from the right that says Purdue at the top, so these would be using our numbers, but first on planted acreage, that's 89.1 was the report out Friday. We have the difference there, that's 1.1 million more acres than the March planting intentions report, so USDA will use that 89.1. Then yield, I used 178 here. I'd like to use 179. I think that's where our models are saying. But again, we'll back it off, be a little bit conservative. That's 3 bushels above where USDA is at this time. 4 bushels, excuse me. I got the number wrong there. So let's go to the production. What does that give us on production? Almost 14.6 billion. That's another 500 million bushels, 500 and almost 50 million bushels more corn. So there's one of the big factors for why we have such lower prices. That's a lot more corn. You go down to the bottom line then, ending stocks, gets us maybe something up in the 1.9 to 2 billion bushel carryout, and maybe 360 prices for U.S. Average price. Now again, go back and compare that to the 17-18 marketing year, 2.1 billion bushel carryout, 340 price. So something above 340. So that may be more in the 350, 360 kind of price area. Generally, I figure as a rough approximation, U.S. average price plus 10 cents for a December futures. So using these numbers, 360 U.S. average price, I'd say maybe a December futures, 370. We're trading, I think, Michael, you checked
360, right around 360.
360, low 360, and again, this was the overnights. So again, maybe futures are pricing this new crop corn cash price more around 350. So that's a substantial change, and that's before we talk about any tariff implications.
Let's take a look at the futures chart. There's the December corn futures chart, and it shows May 28th. You've got that kind of highlighted. We were at roughly 430, I think.
Yeah,
maybe.
So that was the high, 430, and again, it was just late May, so this all occurred in just a touch over a month. And we made a low of 358 on December corn futures a week ago Tuesday. And again, that felt like that was a spike low, that was an artificial low. I didn't think we'd retest that, but here we are retesting that at the current time period. Will we go lower than this, or is this kind of a test of the low and a retest of the low? Well, certainly all of us will watch the market very closely in the next few days to see if we can bounce off a little bit of this and have some sense of getting a signal here of a double bottom, a test and a retest, but unable to go through that. Probably the next 2 weeks up to 3 weeks, and the weather, if the weather improves yield prospects more, we probably haven't made the low. If weather is more normal, and more normal in July usually means we have some dry pockets, we have some concern in some areas about the crop, then maybe this bottom holds for now. And then we have the implications of the tariffs. We'll talk about that in just a little bit, but right now we don't think tariffs will take corn prices substantially lower.
So thinking about yields again, Chris, you said you're kind of in that 178 to maybe 179 range at the moment, and much of the trade has really been talking about 180 as a possibility. It's conceivable as we head through July, if the weather conditions are very good, we could be looking at something over 180, in which that would be what you're talking about with respect to maybe testing
making new lows here on this. Yeah. Now, and I think that's right. Again, if we don't get above 180, maybe this could be the low, but even if more people become convinced 180's out there. And is 180 doable? Well, we didn't have a perfect year last year. We had 176.6. Trend yields about 2 bushels. So that basically, take last year and add 2 bushels, you're pushing up 179 or right around the 180. Right. So it can be.
Let's take a look at the soybean balance sheet.
Yeah, and boy, you got 950 a bushel. That looks like a glorious number today when we're looking at beans probably under 850 for cash bids for new crop at this point. Similar format here. The furthest to the left set of numbers is for the 17-18 marketing year we're finishing up now. 505 million bushels of carryout, $9.40 U.S. average price, and obviously we were above $10 a month ago. USDA using their June numbers, and that was the planting intentions report from March, 89 million acres. Following to the bottom, tightening nicely the anticipated carryout on soybeans, 385 million bushels. And that nice round number, $10, most of us would just settle for $10 beans on our 2018 crop right now. I would take some of that right now. I probably wouldn't sell everything. You know, I'd say, well, maybe 20%. Maybe we'll go to 12. But anyway, let's look at the Purdue numbers on the fundamentals here. So the current report on acreage, 89.6 million acres. That's up 580,000 acres from the March intentions. I'm going to use a yield not at 50, but back off just a little bit more conservative. 49.5 for yield, up a bushel from what USDA is using on their trend yield. Go down and look at production under the 18-19 Purdue year, almost 4 billion. That's 115 million more bushels of beans based on a little higher acreage and another bushel above what USDA was using for trend. I put a little more in the crush. Exports is very, very uncertain because of the tariffs that we're entering into. And that gets our carryover 480 million bushels. Maybe we could carry something in the 950 price range with a little under 500 million bushels. So 50 cents under USDA's numbers. Now again, what will USDA do in their update in July? They'll change the acreage. I would guess they will not change the yield. They will wait for the August report to change the yield, but the market is obviously going to evaluate as we go day to day what the yield potential is. So again, if we just had the fundamentals, we'd be dropping, we think, about 50 cents a bushel off of that $10, but we've got more going on in the marketplace right now than just the fundamentals of these basic supply and demand numbers.
Yeah, and I think one thing to think about with yields, Chris, and you mentioned this earlier, but it's probably worth reiterating, and that is the fact that at this point, you know, you're a little above where the trend yield was that USDA was using based on current crop condition. But the real critical period for soybeans is ahead of us, and the reliability of the yield models starts to pick up quite a bit as you approach the 1st of August and certainly as you move into August.
But not until you get out there. You know, mid-July is too early to have a real accurate assessment of yields on soybeans.
Yeah, so which is just another way of saying that late July and especially August weather is very critical on soybean yields.
And we can clearly get a change in weather from what we've had so far.
Yeah, we could have great weather and move well above the yield estimates you've got, or at least above it. Maybe not well above it, but above it. But we could go the other direction as well at this stage of the crop. Right. So a lot of uncertainty there. But even looking at just the acreage and the very modest yield bump you've got in there already, ending stocks up almost 100 million bushels compared to where we were.
And again, our concern is on exports. Normally, when we drop prices on soybeans, we have some response for the world to buy more beans. We just don't know we'll have that this particular year with the Chinese tariffs going into place this, this Friday.
So we'll take a look at that in a little more detail. Let's take a look at the soybean price chart. Here's November beans. A little bit like corn. Late May, we had that peak. We were at 1060 on November bean futures. A little bit like the corn again. We've dropped it really $2 a bushel. The spike low a couple of weeks ago, 864. We've come back here recently and essentially very close to retesting that low. Huge drop though, $2 drop. You just think about that in terms of dollars per acre. That's $100 per acre.
Yeah. And again, nobody knows exactly how much of this is the weather, improved weather, and the higher acreage, and how much is tariffs. But if we'll go back and take the 950 number that we had used as a U.S. average price, I generally figure November futures maybe about 20 cents higher than that. That would put us around 970 on November new crop futures. We're at 870. Yeah. So I just say my guess is that the tariffs are maybe $1 a bushel that have lowered prices. Now, is that accurate? Don't know. Everybody's going to have their opinion in the marketplace, but it's substantial.
It's substantial, and as we were talking before the show, one of the issues here is just the tremendous level of uncertainty that exists in the marketplace with respect to, will the tariffs go into effect? If they do go into effect, how long might they last? What impact would that really have on buyers? And change in market psychology, right? One of the challenges in an environment like this, when you look at a price chart that looks like that, the question is, who wants to step in front of that train?
Yeah, where's the bottom?
Yeah.
Where's the bottom?
And
who wants to be a buyer?
Who wants to be a buyer? Who wants to be along in this market? And I think one thing you and I were talking about before the show was the fact that we've seen a change with respect to both corn and soybean futures with respect to the speculative activity. Funds were very long back when prices were relatively strong there in late May. Most of them have obviously exited and in some cases actually reversed their positions. Just a big change in market psychology, waiting for a new piece of information that would be positive.
Yeah. And I think that change in psychology, the change in the outlook, is across all of agriculture. It's certainly with us. Farmers have been busy getting this crop in the ground and getting it off and rolling, but they have changed their outlook as well, I think.
And unfortunately, here we're dealing with short term. I think this is going to have a lingering impact for months on it, months ahead.
Yeah, and
even once we get past 18 here, there's going to be some uncertainty related.
Yeah, this creates
these issues.
Uncertainty, perhaps even longer term,
yes.
Right? We'll talk more about that here in just a bit. So let's shift gears a bit and talk more directly about the tariffs instead of kind of on the fringe here. So June 15, the U.S. announced $50 billion of tariffs on China for the intellectual property infringements. $34 billion of those scheduled to go into effect at the end of this week, with $16 billion scheduled for later on. And then on June 15, China announced $50 billion in retaliatory tariffs on U.S. exports, including $15.5 billion of that focused on U.S. farm products. And of course, the biggest hit there potentially is on soybeans. Let's look at that in a little more detail, Chris.
We've had several rounds of tariffs, but these are the ones that really, really hit us in agriculture, and that is China putting these tariffs in place this Friday. And I think all of us have been thinking there's still a chance. Our trade teams are talking. There's still a chance. This doesn't look promising. It looks like we're headed for this trade war. So with China, the tariffs that they put on about over $15 billion of our commodities that we sell them, just to run down those, and we think about the Midwest and the impact of is it related to what we produce here? Soybeans, corn, wheat, pork, beef, and poultry. Wow, that sounds like the Midwest. That is right in the center of what we produce that they have retaliated against us. On the other hand, what is really big is the soybeans. Of the $15 billion, you can see in 2017 we sold China over $12 billion of soybeans. And just look at that row in the third column. That's approaching 1.2 billion bushels of soybeans we sold them. And of the total production last year, that was 27% of U.S. production volume last year. So soybeans, you can't say it loud enough, this hugely affects soybeans. Let's look at corn with China. Corn, we sold them $148 million. That amounted to 33 million bushels last year and represented only 0.2% of U.S. production. So what a dramatic difference. Corn is really tiny. Corn sales to China that will be affected by these tariffs of 25% this Friday are very small. So if we lose a portion of that or all of that, it's still not going to have much impact on corn prices, the Chinese tariffs. Soybeans are just huge. Pork is important, that's $1 billion, and beef is important, but those are $1 billion, not $12 billion. So beans are the big deal.
But it's important to keep those in perspective. If you look at pork, that's roughly 10% of U.S. pork exports in round numbers.
Yes.
On the beef side, it's roughly, actually maybe a little over 10% of U.S. beef exports. So those are not trivial. They're not, and certainly not the same magnitude, though, as what we're talking about with soybeans. That's clearly the big hit here. So let's take a look at more directly what this really means on the Chinese side and why we're talking about why this has such a big impact. So Chris, you've kind of crunched a few numbers here.
Yeah, and again, these concepts, okay, we got a tariff, 25% tariff. Yeah, it's not going to make much difference. It's only 25%. So we've placed an illustration here of what is the impact of a tariff as China puts a 25% tariff or tax on U.S. origin soybeans. So let's start on the first line of that visual. It says pre-tariff, the delivered price. We'll just say Brazilian beans are $12 a bushel delivered to China, and U.S. origin beans are $12. Okay, so we are in equilibrium. The Chinese are equally willing to buy on a price basis from Brazil or from the United States. Then on Friday, on just a few days away, on July 6th, the 25% tariff goes on. This is announced. It is starting on this Friday. And so on the Brazilian origin beans, no tax. On the U.S. origin beans, a vessel at a port in China, for them to unload, they're going to have to pay a $3 tax. And that $3 tax, if the contract were for $12 delivered from the U.S., there's another $3. That makes our beans, because they are not the same as a Brazilian bean, they are a U.S. bean, they're now $15 a bushel, or on this Friday they will be. So you can see what happens here is obviously China is not going to buy beans from the United States in the short run. They're going to buy from Brazil. This is going to bid up the price of Brazilian beans. It will reduce the price of U.S. beans, and over time we'll find an equilibrium between those. But the first thing it does is it prices us out of the market. Now, the U.S. is going to need, or China will need to buy U.S. beans. We're too big of a supplier. They'll need to buy quite a few beans from us, but we're the last supplier. We're the residual supplier. And I think we've got some illustration of this just a bit further along.
Before we move to that, Chris, let's just back up, because I think some people have wondered, well, if the tariffs don't go into place until early July, and July 6th is what we've got on the screen, why did it start impacting prices way back in June? And of course the answer is the tariffs go into effect when the vessel's being unloaded. So it impacted sales to China as soon as the announcement was made because of the difficulty in getting the product actually to China before the tariffs would potentially be imposed. And nobody wanted to absorb that risk of taking on the tariff. The Chinese buyers didn't want to take it on, that risk. The sellers on the U.S. side didn't want to take on the risk. So it really resulted in a contraction of trade immediately as soon as the announcements were made.
Yeah, we saw an illustration of this on sorghum. We had vessels of sorghum from the U.S. floating on their way to China. China put in place a 187% tariff, nearly twice what the value of the sorghum was worth that you had to pay in a tariff. And nobody was going to unload those vessels in China. Those had to be rediverted and sold elsewhere. So the surprise of having a contract written and then to have this tariff put in place. That is just something that a month ago I don't think any U.S. grain company would have done unless the Chinese crusher said for sure they'd pay the 25% tariff. Now going forward, well, what if the tariff's taken off? How is that written into contracts? What if the tariff goes to 35%? How is that written in contracts? So I think, in essence, trade between the United States on these major grains and animal products, those contracts just are not going to get entered into until this becomes more clear how long the tariffs may stay in place. Who's going to pay for that?
We've created this level of uncertainty and to some extent fear, and it results in a contraction in
And it's already relating to sales, as Michael pointed out, of the 18 crop we normally would start to be selling to China at this point because of the uncertainty. How long will they be there? Will those percentages change? Will they go down? Will they go up? Will we settle our trade disagreement? Until that's settled, this is going to be a very reduced trading activity time period with China.
So let's kind of walk through the implications a little bit. You've got some of those.
Yeah, we kind of started talking about this, and we just kind of hit it quickly because I think it is important to sort of get the sequence. How does this work? Well, U.S. soybeans, as we pointed out here, become very high cost now to the Chinese. And you say, wait a minute, they're still the same U.S. soybeans. They are not the same. U.S. soybean now has a $3 disadvantage, or roughly a $3, 25%. So China is going to buy all the beans they can from non-U.S. sources first. China is going to need to buy a lot of beans. I mean, we sell them a lot of beans. They can't do without some beans, especially from the U.S., but they're going to buy the minimum they can from us. That's the residual supplier that we become. So that preference for China to buy non-U.S. beans, that stimulates higher prices in our competitors. And the other point that many in the administration miss is that over time, this is going to stimulate acreage, particularly in South America and among our competitors. And we've heard members of the administration say, well, all the beans that are produced in the world are sold in the world, so you're just going to reconfigure where they're shipped. Well, in the short run, that is the case because you can't increase beans in the short run in the next week or two. But what you can do over the next year is South America has a lot of incentive to plant more beans, and we're going to see the bottom line there is if these tariffs stay in place, it's going to discourage acreage here in the United States. And over time, we just lose market share on beans.
Yeah, and one way to look at this, Chris, is if you look at the U.S. share of soybean planted acreage around the world over the last 40 years, it's changed dramatically.
Yeah, dramatically.
The late 1970s, the U.S.'s share of planted acreage in the soybean acreage in the world was roughly 70%. Today, coming into the 18 crop, roughly 30%.
Right.
And this is just going to exacerbate that.
Yeah, and no question about it. Yeah. Go ahead.
Well, let's look at the impact of the tariffs based on a Purdue study that was released just a few weeks ago. A couple of our colleagues in the department did this in-depth analysis using the global trade analysis model. And they suggest over longer term, soybean prices dropping by up to 5%. If you think about $10 beans as a base, that's roughly 50 cents, right?
Yeah, and again, we're sort of a wild guess that the futures have dropped $1. Well, again, this is a long term after you get adjustments. In the short run, if China just doesn't buy a lot of beans from us, I think $1 is not unrealistic to say the impact could be.
But then if you think about the harm, and I think that the distribution of impacts is quite interesting. So they suggest a decline in the U.S. soybean industry of about $3 billion a year. Chinese consumers wind up absorbing higher cost, up to about $3 billion a year. The Brazilian ag economy gets a boost. So who's the winner here? The Brazilian ag economy, right?
Our competitors.
Our competitors. And then if you think about it from an entire world situation, it results in a loss to the world. And I think of this, Chris, as being the equivalent of the deadweight loss of a tax,
right.
Effectively.
Absolutely.
We're effectively putting a tax on the trade of a variety of different products, in this case on the soybean side, that winds up reducing economic activity and resulting in a lower net income on a worldwide basis.
And we describe that as a loss-loss situation. We see the U.S. soybean industry loses $3 billion, and the Chinese consumers lose too. Why would two countries do something like this? And that is a good question.
But be that as it may, that's where we're at, right?
It's for political reasons on other issues of trade to try to get some changes made with our trading partners.
So on the corn side, as you pointed out earlier, it's not as negative. However, I think we're probably seeing some more spillover impacts in terms of this negative market psychology. But we export about 50% of U.S. soybean production on a worldwide basis. China's share of our soybean production in terms of their imports is about 30%. We export only 15% of corn production. That's partly the impact of ethanol.
Right.
That's become such a large component of total demand. China's imports of corn from the U.S. were only about less than 1%, only 0.2% of our production. So the Chinese corn tariff is not going to have a big impact by itself in terms of the influence it has on our supply-demand balance. I suspect there's some spillover impacts in terms of the overall market negativity that's out there with respect to the change in psychology.
Right. And again, on corn, probably Mexico is the bigger concern.
Yeah, so let's turn and look at that. Chris, you've looked at this in a little more detail. I'll let you walk through that.
Okay, so Mexico is a big buyer. They're our #1 buyer on corn, and they are considering a 10% tariff. So this is substantially more modest than a 25% tariff that the Chinese are putting on starting July 6th. So remember, in the second bullet point there, China bought a little bit of corn from us, 33 million bushels last year, but Mexico purchased 580 million, our #1 customer. Soybeans are the big deal in China, 27% of U.S. production last year, but Mexican corn is 4% of U.S. production. So we're beginning to get a measurable number here. As we think about Mexico, Mexico really needs the corn for livestock feeding as well as human use. A lot of their human food is based upon corn. And I think Mexico government is very hesitant to put these tariffs on U.S. corn and other ag products. And the primary reason is they're a developing country and it's going to raise food prices. And food price cost is very important with moderate and low income families. So I think Mexico will be slow to put these tariffs in place. And so corn is, the tariffs on corn that we have with China, not nearly as important as soybeans. And Mexico is talking, but they haven't moved in that direction yet. So right now I'd say the tariffs on corn are threats, but we don't have any reason right now to believe that those will be major price depressing factors unless Mexico does go ahead.
So let's kind of summarize on the corn and soybean side, and then Michael, we're going to come in and talk about the financial implications at the individual farm level here because they're quite large.
Yes.
So Chris, let's summarize. On the corn side, reports somewhat bearish.
Right.
Stocks a little larger, acres up.
Right, and more acres and strong yield potential. That's negative to prices on the production side. On corn, the corn tariffs, so we just made the point, not nearly as important, not very important at all in China. It'll be Mexico will be our greater concern on corn. Michael, you may talk a little bit more about crop insurance. We'd run some numbers, look like 90% coverage on corn if you had normal yields would be about, start to protect below 360 D's futures. That's about where we are now, but that would only be for those that have extremely high coverage. I think usage will be strong. Exports on corn for the old crop are strong. And I think probably on corn what we'd say is there's limited downside price risk from this point. And that is primarily the crop gets bigger and then will Mexico come in and put the tariffs they've threatened on corn.
Let's look at the soybean side.
Again, the stocks was neutral, a few more acres. We've got the yield implications there. Tariffs very harmful. China really the key. Can we get negotiated with them and get some kind of a resolution there? We could become the residual supplier. We're the last one that China wants to buy from. On crop insurance, we had a 10-16 futures guarantee, an 85% coverage revenue product would start about $865 if you had normal yields and protect prices lower than that. If tariffs would suddenly go away, maybe we could still get something in the mid-9 on soybeans. If.
So, Michael, let's take a look at, you've got a, let me set the stage here a little bit. You've got a case farm that you've been working with. It's based on a West Central Indiana situation. You simulated this going back a number of years to trace the financials on that farm. So walk us through that a little bit.
Before we get into the details, detailed financial implications of the drop in corn and soybean prices, particularly looking at the large drop in soybean prices that Chris was talking about, let's talk a little bit about discouraging soybean acres. I want to come back to that a little bit. Chris and Jim were talking earlier about the fact that when we become a residual supplier, that's going to encourage soybean production in South America, but also Ukraine and elsewhere, and discourage soybean production here. And so the era of soybeans being more profitable than corn may be over. Since 2013, particularly in the eastern corn belt, soybeans have been quite profitable compared to corn. Depending on all the things that we've talked about today, that could change. We're looking at putting in next year's crop in the ground. So I did want to say something about that. In terms of the safety net, Chris talked a little bit about the possibility of crop insurance kicking in. But that's assuming that yields are not higher. Right. If we have higher county yields, higher individual yields, prices are going to have to drop even more than 15%. It's an obvious point with 85% coverage, but it does need to be made. And so it's kind of an open question whether we'll get crop insurance indemnity payments widespread this fall. It just depends on where prices end up. I did some number crunching on the Ark County program, and soybeans have to be really low in terms of price in order for those to kick in, particularly in the eastern corn belt. For this case farm, soybean prices would have to drop below $8.40. So the national price would have to be $8.40 or below before an Ark County payment would kick in. And so if prices drop that low, we're going to have some. We're going to bleed a lot of red, and so hopefully they won't drop that low, but they would have to be that low on this case farm for an Ark County payment for soybeans to kick in. It'd have to be even lower on some other case farms I have for Indiana. And so with that, let's return to the financials here. Now let's, to kind of keep in perspective the next slide, this farm had a current ratio of approximately 3 and working capital per crop acre of approximately $370 coming into this year. And so let's look at what would have happened under late May prices versus late June prices.
So for clarity, your current ratio is current assets
divided by current liabilities, okay. Yes. Thank you. And so we had late May prices. This was looking at cash prices, futures prices adjusted for basis, $3.90 for corn and approximately $10 for soybeans. The current ratio and working capital per crop acre were expected to increase. And so 2018, like we were saying earlier, this looked like this was going to be a turnaround year. We're actually going to have some improvement in our financial situation looking at the prices in late May. We were looking at a net farm income at that time on this 3,000 acre farm of $134,000. Now let's move to late June. Take $1.50 off of soybean prices and 40 to 50 cents off of corn prices. And you're looking at a current ratio that dropped to 2.65 and working capital per crop acre dropping to $316. That's a drop of $80 in the working capital per crop acre. If you go back to 2013, we've been seeing drops in this working capital per crop acre since 2013. This would be a bigger drop than in any year over the last 5 years. And so that just puts in perspective how big a drop this would be in working capital per crop acre. Just a very large drop. You take net farm income from a positive $134,000 to a negative $100,000. I've got the numbers right here. They are in red. That would be a drop in net farm income of $235,000 on a 3,000 acre farm.
Approaching $250,000.
Yes, so very, very large difference.
Based on roughly a 30-day movement.
Yeah, based on a 30-day movement in prices.
So this suggests financially, cash flow, could be extremely
Very
tight
tight.
again.
Yes.
We're not emerging from this
Definitely.
tight cash flow
Yeah.
and erosion of the general financial ratios.
Yeah, and this is just looking at 2018. I'm really worried about the lingering impacts of this drop in soybean prices, because again, at $10 soybeans, we were on a lot of ground. We were looking at a break-even situation, perhaps a small profit. We went from that to losing $75 to $100 per acre, perhaps in 2018, and that loss is not going to disappear moving into 2019. And so I worry about 2018 impacts, which are shown in this slide here, but also there's long-term impacts that are also not very pretty.
And let's be honest about it, Michael. If you look at that reduction in working capital per crop acre, there's some farms in Indiana and elsewhere in the Corn Belt that will not survive this.
Definitely, and here I'm looking at a farm that has some pretty strong current ratio coming in. Anything above 2 is a pretty strong current ratio. There's quite a few farms that had a current ratio more like 1.5, and so you take a 1.5 and you take out 0.4 or 0.5 in round numbers, and you got a very serious financial cash flow situation.
Yeah, those are farms that will have difficulty
Very
and
difficult
likely
time.
not find financing for the 2019 crop year. I mean, this is huge, right?
Yeah, it is. And again, how long will it last? Michael's critical on that because land values could not be sustained with these kind of economics.
Yeah, let's
Current
talk a
land
little bit
values.
about that, Chris. I mean, we were thinking that cash rents and land values would be relatively stable. Coming into late May with those prices, perhaps even a small increase, maybe a year or two from now. We can completely throw that out the window if these prices persist. There definitely is a need for a downward adjustment in cash rents if we're ever going to have 850 soybeans.
And of course, we were talking before the show, the Purdue Land Value Survey is underway right now. It probably won't reflect those changes because this was just starting to hit and it was too soon to make those adjustments. So that won't show up for a while, but it'll be resonating as we look at land sales and cash rent auctions taking place in the last half of the year.
And so we thought cash rent negotiations wouldn't be quite as severe this fall or contentious. They probably will be very contentious if we're coming into the fall with fairly low corn and soybean prices.
Yeah. So, Chris, you've taken not this exact set of numbers, but something pretty close, and looked at the aggregate impacts and related that back to USDA's net farm income forecast, which they released earlier in the year.
I'm thinking about the administration talking about they have the farmers back. So how many dollars is that? Well, there'll be plenty of evaluations done about that, but if we just look at the decline in the value of the 2018 crops, taking the production numbers that USDA has, keeping those constant, the declines in price since June 1 to July 2nd, yesterday, that was $7 billion less value on corn, $7 billion less value on soybeans, and about $1 billion less on wheat. So that's $15 billion. Now, we're not saying that is going to be the final evaluation for what it just these three crops declined, and that a government might think about compensation. But it's not small numbers. These are big numbers. Total direct payments from the federal government to farmers has been around $10 billion a year in recent years. These are big numbers.
These are huge
and this
numbers.
is just three crops.
Yeah,
There are three big ones.
When you look at that $15 billion relative to USDA's estimate of net farm income of roughly $60 billion, that's about a 25% decline, right? So that's a huge number when you think of it
from an already tiny, low, dismal income.
And you couple this with the fact that our safety net's probably not going to kick in a big way in terms of both crop insurance and the Ark County. They're just not.
Yeah.
So I think that's important to point out.
Yeah, the safety net was originally designed as more of a transition to a more market-oriented era,
and now not a big drop in 1 month.
And now we've pulled back on that market-oriented farm policy effectively. This morning, just a few minutes ago, the Ag Economy Barometer was released, which is based on our monthly survey of 400 farmers nationwide. And one of the charts that we looked at this month was the share of people expecting lower commodity prices in 12 months. And the barometer was based on a mid-month survey, so a little bit like some of the other information. It wasn't conducted yesterday, so it doesn't fully reflect the decline in prices that we've seen over the course of the last 30 or 40 days. But even as you look at it, you can see the negativity showing up with the sharp rise and the percentage of people expecting lower soybean prices in the year ahead, and actually the same story with respect to corn and wheat as you look at it, particularly as you compare it to the beginning of the year. People were relatively optimistic early in the year. We're losing some of that optimism as the spring unfolded, and then particularly in this last survey, the negativity. And so the barometer itself did not decline this month. It actually went up 2 points based on a current condition index rise of about 6 points. And we think a lot of that was related to the fact that, as Chris pointed out earlier, until the end of May, you could sell corn and soybeans especially at relatively profitable prices for many farm operations. As the month of June unfolded, that changed dramatically. So we'll see what that shows when we do another survey here in the month of July. But clearly a big impact as we're heading forward. So
a real transition period this last 30 days.
So with that, I think we're going to wrap it up. We've got a couple other webinars coming up. We don't have the exact dates scheduled yet, but we will be doing a land values webinar here in August based on the results from the Purdue Land Values Survey. And I think on August, I believe it's the 8th of August, we'll be doing an Ag Economy Barometer webinar. So those are available on the website. If you subscribe to our information, you'll get the emails with the links, etc. So we'll look forward to visiting with you in the future on those. And thanks for joining us today for our webinar. So on behalf of Purdue Center for Commercial Agriculture and Purdue Extension, thanks for joining us.